In this video, we're going to be discussing a 3-step roadmap you can use to balance your career and profits. How you can trade successfully even if you have a full-time job. Now, let's set the premise for this discussion. We're going to provide you 3 different ideas on how you can do this. Ideas we believe are solid that will allow you to be successful at working full-time and trading successfully. What we consider successful is making a difference in your monthly income. It's making a substantial difference in your lifestyle. So some of you might have bigger aspirations to trade full-time one day, and we can help you with that. You just contact us. We can walk you through the process and show you the programs that we have that could help you get to that point. But most people are not going to be able to trade full-time. Just to be honest, most people are not going to be able to trade full-time. But we believe at the Dorian Trader, everyone that has a deep desire to be a part of the markets, to trade the markets, can learn to do it at a successful level. And that's going to look different for most people. Right? Success for someone might be 1% a month. Success for someone else might be 1% a day. It's going to look different for everyone. Right? So we're not going to box people in on what is considered success. But the premise of this video is to help you understand that it's not a lot of steps that you have to take. We believe it's 3 you can take to be successful, kind of marrying your career with trading. So let's walk through those steps here and put some more color around it. So let's now discuss step 1. We believe that step 1 should be trading the ES options on futures. Now, if you've never heard of the ES options on futures, it's just like trading the SPX, that's the cash settled S&P 500 options on stock. It's just options. The ES options on futures is the same thing as the S&P 500, except it's traded around the clock. You can trade the ES from Sunday night to the end of trading on Friday. And it allows someone who has a full-time job that is really busy during the day to be able to trade at night and do it successfully. Now, the ES options on futures are regulated by a different regulator. They're regulated by the Commodities Future Trading Commission. Options on stock is regulated by the SEC. Now, because the options on futures are regulated by a different regulator, then you have some different criteria around it. But for the most part, it's exactly the same as trading options on stock. The only major differences is that you get 1256 contract treatment, meaning that you get a tax treatment, a tax benefit. And I'm going to go over into detail with that to keep this video short, but you can look that up and we talk about it in other videos. You also get what is called span margin. On options on stock, you get regular T margin, and that's where you have to put up your max loss and keep that max loss until you take off the trade or it expires. So for example, if you put on something that's 10 points wide on options on stock, you're going to have a buying power of 1,000, and you have to keep that buying power until you take it off or it expires. On options on futures, you have what is called span margin, which is not static, it's dynamic, meaning it changes. So you don't have to put up your max loss on almost 100% of the trades that you do. You don't have to put up your max loss, you put up a fraction of it. So for the same type of example, if you were doing the 10-point wide, you might have to put, or something that's equivalent to a 10-point wide on stocks, on options on stocks, you might only have to put up, instead of $1,000, you might only have to put up, $200 or something even less than that. Sometimes it might give you a credit to be able to do the trade depending on what you have on your portfolio, because the span margin is based on your portfolio, all the things that are associated that you have on in the futures market. So we believe you should trade the ES because you can trade it at night, and it's super liquid, and it's super popular, and it's just something easy to trade. You don't have to worry about individual stock risk. You're trading the broad market. You're trading the S&P 500. So if you're trading at night and you have a full-time job, you want to simplify the process. You want to make it as easy as possible for you to be able to be successful without putting a lot of stress on you, because you already probably have a stress on your day job. So just focusing on the S&P 500, a broad market index, trading at night so that you can execute your trades without worrying about someone interrupting you at work or something such as that. We encourage you to use the ES options on futures. You can get access. If you don't have access to options on futures, we can help you get access so that you can trade at night. Everyone should be able to do it. You just have to be with the right broker. We can help you pick the right broker, help you sign up with that broker, help you set up your platform and understand what's going on. We can walk you through the steps so you can get this going and be successful. Just consider joining the Dorian Trader. All right, so with that said, once you identify and get all set up with trading the ES options on futures, step number 2 is that you should trade a bull put spread with a hedge. Right, so a bull put spread is a basic type of strategy that you're bullish, but you can be right even though you're wrong because you're putting the trade on super far the way we teach you. Right, so you can be right irrespective of market direction. So when you're doing a bull put spread, we encourage you to do it really far out of the money. So an example here, we're going to go down to the 4,000 strike here, and we're going to sell a 100-point wide spread. So on the ES, each point is $50 a point. It's not 100 like it is with all options on stock. Options on stock are uniform. Options on futures are not. You have to know the denominator. So, but we're encouraging you to only trade the ES for now. And when you're trading ES, each point is $50. So your max loss on this trade is 5,000 because it's 50 times 100. So that's all you need to know is that options on futures are treated just like options on stock for the most part. You just need to know the denominator here. Okay? So this is a 100-point wide spread. You have a super high probability of winning on this trade because you would do it far away. What we teach at the Dorian Trader is you initiate no higher than a 15 delta, ideally no higher than a 7 delta, super far away using options on futures. And you can see here that you're going to collect almost $163. Your max loss is just above 4,800, and you're not going to worry about that max loss because we're going to teach you how to avoid that max loss 100% of the time. I guess nothing's 100% of the time, but in our world, it's darn near that. And then you have this buying part issue, this buying part situation here. You see that the buying part they're requiring is only 645 and your max loss is over 4,800 here. So this is what we mean by options on futures have dynamic margining. It's not static like options on stock when you're doing spreads. This is dynamic. It changes. It can give you a credit or it can require your max loss. Okay? But in this case, it's only requiring about $645. So you would do this trade, and then what you would do is take some of this monies up to 30%, 10 to 30%, and you would buy a hedge. So at the Dorian Trader, we teach people to go into the micro futures if you're not going to hedge in the same underlining in the ES itself, you go into the micro ESs and you hedge. And so in this example, we would go and we would just buy a put spread. A put spread, if you're buying a put spread, it's bearish. If you're selling a put spread, what we just did, that is bullish. So you're kind of offsetting your risk sum. You're not going to offset it completely. A hedge is not to hedge out all your risks, it's just to hedge out a portion. So in this example, you're going to spend about $22 before fees and commissions. So if you used about $30 after fees and commissions, it'd be actually less than that. But you can see that you can still have the chance to make $130 if you held at expiration, which we don't encourage you to do. But if you also would have a chance to make money on your hedge, because if the hedge goes into the money and you win on your hedge and your position that you're trying to win on, then that can just be an added benefit. So I'm not going to go into complete detail in that. We talk about the put spreads in other videos, and we encourage you to go look at the other videos. And then just for a quick note, if you can please subscribe to our channel, we would super appreciate it. We're trying to grow to 5,000 subscribers. And if you can support us that way, if you find value in this video, please hit that subscribe button, hit that like button, and leave us a comment, good or bad. We appreciate it. Thank you. So let's now talk about step 3. Now, step 3 is learn to adjust so that you can execute iron condors. So if you can learn to adjust at a high level, then we encourage you to be able to do iron condors as well. So when you do an iron condor, you have risks on both sides. You have a risk on the put side and you have the risk on the call side because you're selling a put spread and selling a call spread simultaneously. So you want to be able to understand how you can adjust those positions, how you can adjust within the same expiration period, and how you can roll those out at a high level so that you can be able to win 90+% of the time. And when you lose, the loss is small. Okay? So if you learn how to adjust, then we can teach you how to do an iron condor. So based on that same kind of trade we just did right now, if you sell the 4,000 put again and you buy the 3,900 put, and then this time you go over to the call side, and I just say you sell the 4,800 call and you buy the 4,850 call. So on the put side, we had a 100-point wide spread, and then on this call side here, we got a 50-point wide spread. And so we kind of skewed it. We skewed it by the width of the spreads and potentially skewing it by the deltas, and you can also skew it by how many contracts you do on one side. But in this example, we're 1-in-1, but the put side is 100 points wide, the call side is 50 points wide. So you can see here now we are collecting almost $238, and the max losses dropped a little bit because we're collecting a little bit more, but still around that 4,800. And you can see that the buying power has dropped about $100. Right? So we're collecting more, buying power is less, so we're having a bigger return on your capital. This is once again an iron condor. You have to understand how the dynamics of that works. So if you know how to adjust, you can win at a super high level. So we encourage you to learn step 3, learn to adjust so you can do these iron condors at a high level. If you don't know how to adjust, then we encourage you to just start off by doing the bull put spread and adding a hedge to it like we just demonstrated. And then you only have risk to one direction, and that's if the market goes down, and it has to go down in a significant way, usually more than 10% before you have a problem if you're doing a swing type of trade 30 to 60 days. In this example, we're showing 54 days out. So you're giving yourself the opportunity to win by being super far away, making things super simple, because you don't want to convolute things, because the more parts that are moving, the more things that you can drop, the more balls that you can drop. So you want to simplify it. And these 3 steps are simplifying things. You're only trading one underlying. That's the ES. Right? You're only doing one strategy initially. That's the bull put spread with a hedge. And once you master that, once you understand that process, then you move on to the iron condor once you understand how to adjust. That's step 3. And you stay with this process, you can make a ton of money just trading the S&P 500, not having to worry about individual company risk. We can teach you that at the Dorian Trader. So if you have any questions, please leave some comments. If you're considering joining us, please visit our website. We thank you for watching this video. Hopefully you'll see you in the next one. Bye for now.